All right, welcome back to the podcast. My name is Doug Sandler from Turnkey Productions. That guy over there from Southern Florida. I was about to move you to Southern California with me, John, but
Oh,
I
no,
know
thanks. I want to stay. I'll stay here. Yeah.
understood. Well, yeah, your family probably wouldn't tolerate the fact that you'd be 2,700 miles away. My family actually applauds that I'm 2,500 miles away from them. So
Yes.
no excuse here. So, John, today we're going to talk about the power of zero taxable income in retirement. How is that even possible? I only know a couple of words that might align with that, but I want to let you lead the way here. What are we talking about? Power of zero taxable income in retirement.
Yeah, this is super important. And I think vastly misunderstood by folks. And they said it's not possible not to pay taxes. Death and taxes are the things that we know are going to happen. And true, right? I mean, you have to pay taxes and we should pay taxes. We should pay our fair share. However, the tax code and the like is set up that if you know what you're doing, and you pay attention, there are ways that you don't have to pay as much tax as if you aren't paying attention and you do not do your planning, which frankly, I think we're in the probably the 90 percentile of people who just because they don't know and because they either they want to do it themselves or
Hmm.
they think they don't want to pay somebody to do it, the do it yourselves or whatever, they miss out and they end up paying thousands at least, if not hundreds of thousands of dollars in taxes that they really shouldn't have had to do.
All right. All right. So let me ask a question and then you can lead into it from here. I have been in the workforce for 40 years, roughly. And in the 40 years before I got into it, there was no uh, put money in now, post tax, but all the interest and all the other stuff is you don't pay taxes on the interest. So I was just always a contributor to a 401k plan.
Mhm.
So now I haven't paid any taxes on that money that went into that account, right?
Right.
All the money it's sitting in there, it's tax deferred. So later on, when I get to retirement, I'm going to do that. It seems like I've already broken the rule of being able to go zero taxable income in retirement because don't I have to pay money on that taxes on that money that's coming out?
You do. And there's a way to do it the right way, and there's a way to do it the wrong way.
All right. Well, teach us only the right way. Maybe warn us about the wrong way, but teach us the right way.
So many people will talk about the Roth, and we've gone over that before on this podcast. The
Hmm.
Roth IRA and the Roth 401k, if you have access to one of those, great ways to put aside money that is uh, already been taxed, and
Hmm.
then it grows tax free and it gets withdrawn tax free. Fantastic, except for the fact that if you make over a certain number of dollars per year, you're not eligible to contribute to a Roth. And except if you contribute to a Roth and you're in the highest tax bracket, it might not be the right time to contribute to a Roth, and tax deferral might make more sense. Again, here we come back to that nasty word called math.
Can you have both? A
Okay,
Roth IRA and a regular IRA also?
absolutely. Yeah.
Okay. All right. So tell me more. I'm interested.
All right. So there's several different ways to get money into that Roth at the right time. I tell people if you give me 5 years, we may be able to get you to 0%. It's really it is a possibility. If you give me 7 or 10 years, we can probably get you into a 0% tax bracket. I'm gonna say it's high
Is
probability we can.
is it to the detriment of the next 7 years? If I am I I'm assuming maybe I'm assuming wrong. Am I slowly taking money from converting money from my 401k that is tax deferred and changing it over to a Roth? Am I paying taxes on that money now though?
Yes, you always have to pay taxes. No
Okay.
getting away with that.
Okay.
And another common mistake is that people will put all of their money into a Roth. And that's not a good idea either because you want to take full advantage of your standard deduction when you're in retirement. So
Hmm.
there's no reason to pay tax at all on that money.
Okay.
And anything that you pay your investment advisor could be taken out of that deferred account, and so you never pay taxes. So there's a reason to have a bucket, so to
Mm-hmm.
speak, of tax deferred. Keep in mind, the better you do in your tax deferred 401k or regular IRA, the harder it is to get to zero because there's more to withdraw and more to pay taxes on.
Now, you have to walk the delicate balance between tax deferred accounts versus the Roth style accounts with the age that you anticipate. There's a whole gentle balance between all of these things, right? Because you said 5 years, you're good. You could probably do it. 7 years, maybe even a little bit more. You absolutely can make it happen. Uh, so that obviously involves how much time you have between now and retirement.
Yeah, it really does require a blueprint, a roadmap. How am I going to do this? And that requires adjustment because things don't always happen as we plan, right? Sometimes we make more, sometimes we make less. There's a bonus,
Mm-hmm.
there's a layoff or whatever, and we have to adjust. But having that plan and starting to follow that plan earlier rather than later is a really great idea. And it all has to do with timing. So the math on this, and this is so difficult for people to understand, I almost have to literally show them on a spreadsheet this
Right.
because all else being equal, it does not matter if you roll into a Roth earlier or later. Okay. All else being equal, because you're either going to have less money to put to work because you paid tax on it,
Right.
or you're going to have more money that's growing and you're going to have to pay tax on it later at a higher amount because it grew.
So is the as we are drawing down money from your tax deferred accounts, rolling them into an IRA, I'm assuming there is a certain amount that you're allowed to contribute to that Roth in on a yearly basis. And
Also
then,
true.
okay, so that would be the part one of the question. Part two of the question is the money that I have to pay in tax liability from withdrawing from that tax deferred account is based upon my current tax rate, correct?
Yes.
Okay.
Correct.
So I'm pulling money from my, now what if I'm not coming from a tax deferred account, but I'm just going right into a Roth? Or are you saying this really works best if you already have a tax deferred account and you're rolling it into the Roth? Or do I not, it doesn't matter if I have either one of those. Can I just start and fresh and start doing it? Or tell me what makes the most sense. Sorry, I hit you with a bunch of stuff there. My brain started rolling, John. I couldn't
I
stop.
know. I can see it.
I
There's
just started
smoke
going
coming out over
on.
there. That's
There
good.
is so much to think about.
So a couple things to keep in mind: if you're under 50, you don't have the catch up provision, so you can only contribute $7,000 a year. If you're over 50, you contribute $8,000 a year. John, that's not going to cut it. $8,000 a year is not going to cut what I need for retirement. Well, you also have your 401k. You can contribute another 23,000. Okay, so what is that? 30. My brain's not
31,000. So what you're saying is the 8 and the 23, 31, I can roll it into my Roth from my 401k if I'm over 50 and use the catch up provision. So I got 31 access to $31,000 if I have access to 31 grand.
Well, I'm just saying that there's all kinds of restrictions that you have to be
Okay, I
aware
got
of.
it. Okay.
We'll just go with that. Yeah.
Okay. Okay.
Um, and there's only so much that you can save, but over time, so you've got this 401k that's built up to say $1 million, but it's not really $1 million because 250 of it is going
Right.
to Uncle Sam.
Right. Right.
So when you take that and you do what we call a Roth conversion, which you pay taxes, the key is people tend to think, well, I've got to take the whole amount. You can take small amounts, whatever amount makes sense, and you use your tax bracket at the time.
Mm-hmm.
And it is okay. People have such a hard time with this, but it is okay to go into a higher tax bracket. It's just that you don't want to go too far in that direction. And so by taking that regular IRA or that regular 401k and rolling it into a Roth, that's going to increase your taxable income for that year. And you want to know where your next tax bracket lies. But it's
Wow.
okay to go a little bit into that next tax bracket based on how long you have to get this done before you retire. Because while it does not matter when you do it, it does matter if you're starting your withdrawal phase. And that's where within 3 years of retirement and drawing things down to pay
Hmm.
yourself in retirement, you are ahead of the game to be in a tax-free Roth type of instrument rather than a taxable IRA or 401k. And there's
Ultim-
there's even more, by the way.
Ultimately, is the goal to take everything that is in your tax deferred status and put it into a Roth, or it sounds like there's still that teeter totter of balance there because I'm sure there are some implications to not having money in that tax deferred and putting it all in the Roth.
Right. And that's what I was mentioning earlier. You always want to have some in that tax deferred account because as long as you're taking advantage of your standard deduction, which we have it now, I don't anticipate that is going away in the future.
Okay.
There'll be some sort of standard deduction, and you want to be able to take advantage of that. And if you don't have anything to take advantage of that, then
You're just giving it back to the
yeah,
government.
you just basically paid taxes that you didn't have to pay again.
Got
So
it. Got it.
yeah, so you always want to have some. That's
Okay. Is there a minimum drawdown amount that I have to take from my Roth? Let's see. Hold on a second though. The Roth is not taxable in when I'm
you're in
pulling that
retirement,
money. Right, right.
right?
Okay. So there really is no there's no downside to this. There's only upside unless I'm missing something here.
That is, I mean, essentially you're correct. You could do it too fast and end up paying too much in taxes. It's really the speed at which you do it.
Okay.
And it's also important to, it's not just a Roth story. That's
Okay.
where I think people get held up as well because they're like, oh, I only have one tool in my toolbox to use. And it's just not enough, John. I'm not going to be able to survive in retirement based on the amount of time I have and how much I'm able for the rules to put aside. Well, there's other things that you can use. You can use a LERP
Okay.
plan because
I'm
we need another acronym.
Yeah, what is LERP?
You can use a life insurance retirement plan.
Okay.
They're like, well, I don't need life insurance. I don't, nobody's depending on me. Well, it's not necessarily really completely all for life insurance. The idea is that you put money aside and you have all the benefits of a life insurance plan, which could potentially include a long-term care,
Mm-hmm.
even if you're in your 70s or whatever. And there goes my screen on that.
I saw that. I saw that was pretty cool. That was technology in action
And
there.
there we go.
For those that are listening on audio, have no idea what we're talking about. John just put his thumb up, like gave it thumbs up, and he saw a little thing on the Zoom screen that was a
The
thumbs up.
emojis, the emojis have taken over.
Yeah, that was good.
So you purchase this life insurance, and yes, there's a death benefit, which by the way is tax free to your heirs. So you get $1 million life insurance policy. You kick the bucket. They're sad, or maybe not. They're sad, but they also get $1 million check. That's tax free to them, and also the cash value of which you can, if you buy the right life insurance plan, you can borrow from. Well, is borrowing taxable? No, it is not taxable. So you're just borrowing from that life insurance plan, and you can do very large policies. They got to be within reason, and but that's another way to put aside money for retirement for those of you who are constricted by only being able to put away a certain dollar amount in IRAs and 401ks and the like. And the next question that I always get on this is, how do I do this? I'm not old enough to take a distribution from my 401k so that I can roll it
Oh, that's
into
interesting
a Roth.
question. Don't you have, isn't there some kind of exclusion or something like that? There's got to be.
There it is. You have to follow the rules. Stressing this, you must follow the rules. And once you start the program, you cannot stop the program.
Whoa.
But there is a way. And if your CPA wants to talk to me and because they don't know about it or whatever, I'm happy to do that. Most CPAs are going to know that this is a thing that you can take an equal amounts and equal installments over each year. I forget the age, I think it's 50. But you can take those equal installments. You have to do it over a certain number of years, has to be equal.
Mm-hmm.
And you can take that out You can then convert that into your Roth. Now, the danger of that is that you get a windfall in one of those years and suddenly you're in a higher tax bracket than you anticipated or something
Mm,
like that.
gosh.
But
Yeah.
it is a way, but none of this is absolutely foolproof. There's still some risk either way. You can't like just know that things are going to happen exactly like, because it's life. Life is
It
messy.
it's absolutely a blueprint that you need to follow. And if you're in our listening community and you're not doing this on your, I mean, you're trying to do this on your own, you can see the challenges that are involved just by listening to an episode of this. This episode was not designed to confuse anybody, but it's interesting how many nuances to this power of zero taxable income in retirement can hop into your path. So,
Yeah.
yeah, yeah. Any final words on this before we wrap up?
Just two things I wanted to mention. The reason that I want to put this out there on the Building Your Life podcast, and it was something I wanted to do, is because you know who really takes advantage of this stuff? It's the ultra rich. And that hardly seems fair. So here you have the information now. Anybody who watches this YouTube now has the information. They know, they may not know how to do it or whatever, but you know that you can go to a quality financial advisor or tax advisor, and they can do this for you. And it's not prohibitively expensive. It is very reasonable. But most people that are just normal everyday folks, they don't have millions and millions of dollars in the bank, don't know to do it. But it is available to you. So that's one thing. The second thing, and my brain is freezing up on me. I was trying to remember what else I want. Oh, I remember now. So many people will not understand this. Even my own clients, even though I kind of tell them about it in advance,
Hmm.
in your Roth portfolio, that is where you want the most growth. You want the most growth, the most income. You want everything that should be supercharged. So your Roth account may fluctuate wildly because it's going to be in a riskier portfolio,
Really? Why is that you want your most volatile money in the stuff that you've already paid taxes in?
because you want the most growth there. And the
Ah,
most growth probably means that you're going to take the most risk and it's going to be the most volatile, but it's also going to be the often the last bucket that you tap into,
so we
so you
have the
have more time.
time into our advantage there.
And then you put in the other portion of your portfolio, your regular taxable account, you've got your conservative stuff. Well, why is that, John? Right? Why? That's the obvious question. Why? The reason is it's harder to get to zero if you have a lot of growth in your taxable account that you're trying to get rolled over. Right? So just remember, it's yes, it's in two separate buckets, but it's all yours.
Right,
So the risk parameters of this little bucket over here of the Roth can be
right.
different because overall you have the same risk parameters when you combine them all together. So you have your less risky portfolio over here, not moving around as much, and the other one, but all together they're at the same risk level that you have decided you're okay with.
Understood.
But that
Understood.
that happens to me all the time. My clients are calling, why is my Roth, the market's going down. Why
Right.
is my Roth doing so badly? Well, that's why.
Interesting. And man, there are so many opportunities here for us as consumers to screw this up completely. my my advice, if there is any advice I'm going to provide, is to seek out a guy like John Browning at Guardian Rock Wealth so that we can get you on the right path. So John, let everybody else know in our listening community how to reach out to you because I know they're going to want to ask you some questions about what we talked about today.
And I would love that because I am a nerd and I love talking about this stuff. It's like putting puzzle pieces together, and when it's all finished, it's just a lot of fun. But best way to get in touch with me is at guardianrockwealth.com and the contact us section, or go out to your cell phone. You type in 321-421-5213, and you put the word life in there and you text that. You'll get back a link that's going to give you all sorts of information, all for free, and also a link to my directly onto my personal calendar. So it's not a member of my team, it's actually my calendar. So those are the two best ways to get in touch with them.
All right, Mr. Browning, thank you for sharing your wisdom and your expertise on the podcast today. For those in our audience, check the show notes if you want more information about how to get in touch with John, or you just can't figure out technology or how to get those darn iguanas off your head. Listen back to a previous episode. You'll know what we're talking about. Thanks for being here, John. Thanks for sharing.
All right. Thanks.